Hey, everybody. Welcome to the weekly wrap up for Friday, April 8th, 2022. I hope everybody's having a fantastic day out there. I'm a little distracted. I'm watching some baseball here on the television. Not Astros. Yankees in Boston playing in New York. It's tied up 4-4, bottom of the ninth. Been a pretty good game so far this afternoon. So hope everyone's having a fantastic week. It's been pretty good here in Colorado, even though I was in a bad mood yesterday after doing my taxes. But hey, got to feed the welfare people who live off the government. So, all those government jobs, I call them welfare queens, but got to take care of those folks. They can't starve. So anyways, pretty good day. I guess depending upon which part of the market you're looking at, some of it was good, some of it was bad, kind of disjointed today. So let's go ahead and take a peek at the indexes for today. The Dow Jones finished up 0.4% at 34,721. S&P 500 was down 0.2% at 4491. NASDAQ was down 1.34%, closing at 13,711. Small caps were down 0.82. The VIX did recede 1.81% today. It's at 2116. Let's see. The other Americas, Canada was up 0.18. Brazil down 0.57. Mexico was down 1.2. Heading over to Western Europe, everything looks green from Germany, UK, France, Euro, Netherlands, Sweden. All of them were up over 1%. Was this Italy? Yeah, Italy was up over 2%. So really good across Western and getting into Eastern Europe. Looked pretty good. The two Russian indexes were down 162 and 1.14. Moving over to the Asian markets, again, lots of green. The first red I see is the SZSE component out of China. It was down 0.11, but everything else was in the green from the way it looks. I mean, nothing dramatic, maybe up as high as 1%, but pretty good as far as how that was going. Let's take a peek at the indexes for the week. So, all right, the Dow Jones this week, let's see, it finished down 0.19. S&P 500 finished down for the week 1.29. Ooh, NASDAQ. NASDAQ, let's see, it finished down, looks like about 3 3/4. The Dow Utilities had a big step back on Monday, but finished up for the week 166. And the Dow Transports looks like it was probably the worst of the week. It was down 6.66%. So not a great day for not a great week for most of the equity markets here domestically. Let's go and take a look at the longer term trend on the Dow Jones. As we can see, here was this. What day was that? Looks like about maybe 2 weeks ago, we did start to cross over this resistance line, as we can see right here. Since the first of the year, it's been up, down, up, hits that resistance and goes back down. And I was expecting it to bounce back down, but it did cross over and has kind of just been floundering out here. So if I were to take a guess, I'd say higher than 50% probability it'll probably, rejoin this channel and head back in this southeastern direction. So we'll see. It is a long-term game here. So obviously you want to try and, I don't want to say guess, but you want to make an educated decision on, whether or not you want to stay in equities long-term or if you want to make some adjustments. But everyone in the news has been saying recession the last few weeks. So I would not be shocked if that's where things are going to wind up here in the very, very near future. But again, I could be off. I could be completely wrong. It does happen. So, but all right, let's go over to some of the economic reports. U.S. initial jobless claims came in at 166,000. Forecast was 200,000. Last week's number was revised down from 202 to 171. So, brought last week's number back under the forecast. Continuing jobless claims came in at 1.523 million. The forecast was 1.311 million. So, about 200,000 over forecast. Last week's numbers were revised up from 1.307 to 1.506. So, pretty big jump, and it's in line with what this week's numbers are. All right. Factory orders month over month came in at a negative 0.5%. That was the forecast. So, I guess some of the forecasters are starting to see that there is a little bit of slowing. The U.S. Services Purchasers Managers Index came in at a 58. The forecast was 58.9. So again, we can see, we did drop off here a few weeks ago, and it has started to climb back up. But still not as high as it was a few months ago. But it is in line with where things have been for the past few years. All right. So I got a couple articles I'm going to breeze through here. I got 2 articles and 1 video. So first article here is just a recap of today's stock market. The S&P 500 was flat Friday as gains in financials and energy offset weakness in tech stocks amid pressure from higher treasury yields ahead of the start of the quarterly earnings season next week. Technology stocks, which are on course to snap a 3-week winning streak, kept the broader market in the red as investors remain wary of growth sectors of the market in the wake of surging treasury yields. The 10-year treasury yield jumped above 2.7% for the first time in more than 3 years on expectations for aggressive Federal Reserve tightening to stem inflation. The Fed's March meeting minutes showed the Fed members appear, quote, poised to hike rates 50 basis points in May and initiate a sizable drawdown of the balance sheet beginning next month, end quote, Seifel said in a note. Big tech, excluding Facebook, fell more than 1%, while an ongoing decline in chip stocks added pressure on the broader tech sector. Banking stocks, which have been under pressure in recent sessions on worries that potential recession could increase bad debt for banks, finally found some reprieve as investors looked ahead to quarterly results from major Wall Street banks next week. JP Morgan reports results on Wednesday. Citigroup and Goldman Sachs, Wells Fargo, and Morgan Stanley report on Thursday. Quote, banks are a good place to be in the upcoming economic environment, not just because rates are going up, but I think the consumer still is in a position of strength, end quote. Jimmy Lee, founder and CEO of the Wealth Consulting Group, told Investing.com in an interview on Friday. While rising rates boost lending margins and profitability for banks, the pace of the increase in rates has driven up borrowing costs and impacted demand. The red-hot pace of increasing rates will be determined by whether the Fed follows through on its hawkish plan to tighten monetary policy. See, that's a big wait and see. If the Fed, turns chicken and turns tail at the first sign of any sort of hiccups in the economy and lowers interest rates or starts QE again, we're headed for a really bad path. I mean, I don't think we're headed for a good path as it is, but they're just going to make it worse in the end. Let's see. Quote, most people believe energy stocks were up more than 2%, buoyed by rising oil prices as investors weigh up the prospect of energy supply disruptions after the European Union confirmed new sanctions, including a coal embargo against Russia over the latter's invasion of Ukraine. Quote, Russia is being forced to scale back its oil production due to the strike by buyers in the West, end quote, Commerce Bank said in a note. Russia is reportedly producing 500,000 barrels of oil per day, less than the March average, Commerce Bank added, citing a report from Bloomberg. Coterra Energy, EOG Resources, and Occidental Petroleum were among the biggest gainers, with the latter up more than 6%. In earnings news, WD-40, better than expected quarterly earnings and revenue offset, softer full year guidance sent its share price more than 7% higher. So some encouraging news. But like I said, if the Fed gets chicken and caves to the pressures of big business and the government, we're just going to be right back in the same spot, just further behind the curve again. All right, next article. It's an opinion article. It's now clear that the Federal Reserve has made a huge monetary policy error. I could have told you that 2 years ago. But hey, no one listens to just the simple advisor sitting here in the mountains. All right, starting out in May of 2020, I was on Anthony Pompliano's podcast describing the likelihood of high inflation in the coming years and the Federal Reserve trying to catch up to it. Turns out it all came true since then. I said the following at the time, quote, I don't see how, say 2021 or 2022, that if the economy is really rebounding, that we don't have 3, 4, 5% core inflation. I think you could have the Federal Reserve chasing their own tails, raising rates, end quote. We shouldn't blame the Fed for everything. After all, the central bank didn't cause all of the current inflation. That was mostly created by trillions in government spending, the Treasury and fiscal policy, and the complex mess of supply chain snags during the pandemic. But the Fed could have done a lot more to get in front of rapid inflation before it got out of hand, and that's where its response is worthy of criticism. Unfortunately, the subjective nature of discretionary interest rate policy has left the Fed doing what it typically does, looking at the 12-month trailing data in a reactive manner and then responding when it becomes clear that the economy is drunk. The Fed wants to swipe a punch bowl that it should have been watering down long ago. The problem is policymakers are on the verge of swapping the punch bowl with sleeping pills as part of the economic look. The economy looks increasingly fragile. The Fed is now at risk of tightening policy into an economic slowdown. Let's look at the risks of recession among other indicators. A flattening and inverted yield curves, which always precede slowdowns and recession, like we had back in 2019. Crashing freight data. Number 3, sharp drop in mortgage applications. And 4, China PMI contraction. Those signals are leading indicators of worsening economic slowdown. At the same time, we've transitioned from an economy where a demand-led price shock has increasingly transitioned to a Russia-led supply price shock. And yet the Fed feels the need to play catch up to try to save face in the wake of what is already proving to be a policy error. That is, leaving rates at zero for way too long. Of course, it's easy to be critical after the fact, but the Fed had been following a more automated policy approach. I've written about a modified Taylor rule in the past. For example, it would have been more proactive and might have been able to dampen inflation before it was too late. Instead, policymakers relied too heavily on subjective opinions of few economists. I am increasingly concerned that the Fed is on the verge of a significant policy mistake, raising rates into an economic slowdown after what is already a policy mistake, leaving rates at zero for too long. But maybe it isn't such a bad thing in the long run. Yes, it could all contribute to a recession in the short run, but in the long run, it should make us all revisit the notion that 12 economists in Washington, D.C. should have discretion over the most important interest rate in the economy. Yeah, I personally think we should have sound money, dollars that are, or whatever currency we use should be attached to something that is tangible. But hey, no one listens to me. I'm just some guy. All righty. Last thing I have here is a video. It comes from John Malden, and this is an interview by Ed DiAgostino, and the person he's interviewing is Jacob Shapiro. They're talking about what's going on over in Russia and Ukraine. So we're just going to play a couple of minutes of this, and then I would suggest at your leisure, follow the link, and you can watch the entire video on YouTube. So let's go ahead and start this. Oh, actually, let me make sure I have my sound on, because if I don't do that, then I'm going to be listening to something that you can't hear. All right. Let's go.
What you said, Dimitri, posited there.
Yeah, I mean, Zelensky's been asking for help repeatedly. And so far, the only help that he's received has been military weapons and sanctions from the West. And granted, those sanctions have been severe, and there's more sanctions being added seemingly daily from the West. But my question to you on the sanctions is, sure, they inflict pain, but do they drive change? Putin must have known that sanctions would be coming. And I think he's smart enough to know that those sanctions, even if the war ended tomorrow, those sanctions would probably stay in place for many, many years. So he was to some extent prepared for it. How effective, in your opinion, are they in affecting real change in this conflict?
Yeah, that's a great question. And I was supposed to have a discussion with a sanctions expert on my podcast earlier today, and he had to cancel because so much stuff is happening that he had a bunch of things going on, which tells you that a lot of things are changing in real time. I would also just quote for you what the Russian ambassador to Sweden said a week or two before the war started. Somebody asked him if sanctions were a deterrent, and I'm quoting him here. He said, "We don't give a shit about sanctions." That's what he said to the Swedish newspaper. So I think there's a real sense that in the United States and the West in general that sanctions work, but they really don't. I believe it was the Peterson Institute that did a study a couple of years ago looking at when the U.S. Used sanctions for foreign policy goals, and it was something like they only succeeded 20% of the time. I mean, just look around the world and you've got countries like North Korea, like Iran, talk about China. I mean, there are all of these problems around the world that the U.S. has sanctioned out the wazoo, and it hasn't actually fundamentally changed anything. I think that's one of the things that in all the virtue signaling and all the self-righteousness about this war, the fact of the matter is, and I think Putin had this calculation right, Russia cares more about what's going on in Ukraine than the rest of the world does. So he's going to take more pain. He's going to be willing to be there longer. He's going to sacrifice more than anybody else around them. And these sanctions, unless you're going to go after the lifeblood of the Russian economy, unless you're going to go after oil and natural gas, none of this is really going to touch Russia. Yes, it will affect them. Yes, it'll make things difficult. But as one Russian analyst said to me when I was speaking to him last week, so what? We're not going to have French wine and Teslas. Big deal. This is about bigger things than that. So if the West is going to be serious about sanctions, there's one path to do it. It's oil and natural gas, and then get ready for a spike in energy prices and a lot of demand destruction in Europe over energy, because that's the only way you get there.
All right. So that's a short little bit there. I have to agree. I mean, I don't think the Russians are actually being punished as much as we think they are. Looking at the conversion rate of the ruble, it's already back to pre-invasion levels. So, the ruble did fall for a week or two to 3 weeks max, but it's back where it was. So I don't know if we're really doing anything that's putting any hampering their style. If anything, we're just making life more miserable for us while these two countries settle their conflict. So, anyways, we'll see where it goes, but definitely some good information there. It's about a 20-minute video. I would recommend turning the speed up to about 1.25 or 1.5. Makes it go a lot faster. If you're not already doing that for my podcast, I would suggest it simply because I do talk slow and I and ahs a lot. So, I'm doing this. I don't have a script, so I'm doing this, off the top of my head. So, if anything, I do stumble over my words from time to time. So, but again, I'm not a professional video person. I'm just a financial advisor trying to help people from my little office here in Colorado. So, all right. Well, that's everything I have for the week. So I hope everyone has a fantastic weekend. Astros won last night. It was an Astros after dark. They went till after midnight in the Central Time Zone, but they won 3-1. A couple of home runs from Jordan and Breggy. So definitely was a good game. Fromber was excellent on the mound. I think he had 5 or 6 strikeouts. So it was, we were a little worried at the beginning of the game. Shohei Ohtani was starting for the Angels, and he was mowing down people left and right. But we got his pitch count up too high, and he was gone rather early. So, anyways, like I said, hope everybody has a great weekend. If anyone has any questions or worries or needs anything from me, do not hesitate to reach out. You can go to dsafinancialgroup.com. All my contact information is there. So if you want to give me a call, send me a note, book a meeting, it's all there. All right. I'll be back on Monday with the weekly economic update, and I hope everyone has a fantastic weekend. Bye-bye.